Hello everyone, and welcome back to the US Stock Market Daily. Let's dive into what's been shaking up the crypto world today. It feels like just yesterday, everyone was panicking about the macro outlook. And today, the entire narrative has flipped. The market sentiment turned on a dime, shifting from risk-off to cautious optimism almost overnight. So, who's behind this push? The data I'm seeing points to the whales. They've been quietly accumulating over the past week, adding a staggering $3.3 billion in Bitcoin and another $1.73 billion in Ethereum to their bags. That buying pressure sent Bitcoin and Ethereum soaring, leading a strong rally across the board. It just goes to show, once the fear subsides, the smart money knows exactly where to find a home. Now, let's get into the topic that absolutely set the internet on fire today. If you spent any time on X in the last 24 hours, you could not have missed the storm brewing around XRP. I saw it unfolding and it was pretty wild. The community's excitement just exploded. And the trigger? A single image, a highly provocative price prediction chart. An analyst by the name of JackTheRippler posted a price roadmap for XRP, drawing a path to over $700. Honestly, the design of that chart was genius. It distilled complex analysis into a powerful visual symbol, giving retail investors a tangible, quantifiable dream of wealth. The result was that this chart went viral, becoming an anchor for speculative sentiment. But here's where it gets interesting. This wave of hype isn't just built on thin air. I dug a little deeper and found that behind the community's frenzy, there are some very real technological advancements providing support. The XRP ledger, or XRPL, has been making some significant moves lately, especially with the upcoming Ripple 2.5.0 release slated for mid-2025. It includes a host of crucial upgrades, like an enhanced AMM feature and tools specifically designed for institutions like tokenized and permission DEX. These aren't minor tweaks, they're paving the way for a robust on-chain DeFi ecosystem and the entry of institutional capital. If the tech upgrades are the internal logic, then the entry of traditional finance giants is the most powerful external validation. Right now, Ripple is integrating XRPL into the global financial system with partners at the level of DBS, Bank, and Franklin Templeton. Qualified investors are already able to trade tokenized money market funds on the XRPL. This sends a very strong signal. XRPL is being seriously used by real-world financial institutions for asset issuance and settlement. Add to that its integration with major cross-chain protocols like Wormhole, which solves the asset flow problem. So when you connect all these dots, you start to understand why market sentiment is so high. It's a classic crypto narrative. The builders at the bottom provide a solid fundamental base, and the speculators at the top ignite the sentiment with a compelling story. Right now, XRP has almost become a leading indicator for the two major narratives of real-world asset tokenization and cross-chain interoperability. Its success or failure would have a ripple effect on confidence across the entire sector. Alright, moving on from the XRP frenzy, let's talk about a piece of news that could be a massive tailwind for the entire industry. For the past few years, anyone following US regulation has had a major headache. The SEC and the CFTC constantly fighting over who gets to regulate crypto. It created so much uncertainty. I remember when Gensler and Bannon were in charge, they were always at odds. One would claim Ethereum is a security, the other would say it's a commodity, and nobody could get a straight answer. Well, it looks like the tide is finally turning. Just recently, for the first time in about 14 years, these two agencies held a joint roundtable. And at this meeting, the CFTC's acting chair, Caroline Pham, dropped a bombshell of a line. She said, "The turf war is over." The SEC chair, Paul Atkins, immediately echoed that, saying the focus now is on harmonization, not a merger. When I saw that, my first thought was, this is a big deal. So why the sudden truce? There are really two forces at play here. One is pressure from Capitol Hill, where they're working on a bill called the Clarity Act, which aims to legally define the roles of these two agencies. The other deeper reason is a growing fear that if this internal fighting continues, America's financial innovation and capital will just flee overseas. So this is much more than just two regulators stopping their squabbling. It signals a shift in US crypto regulation from a confrontational, enforcement-first approach to a more proactive, strategic and coordinated one. They haven't suddenly become pro-crypto, they've become pro-American financial leadership. And what does that mean for us in the market? For the longest time, the biggest roadblock has been regulatory uncertainty. Why haven't pension funds and massive asset managers gone all in? because the compliance risk was off the charts when you couldn't even legally define the asset. This ceasefire between the SEC and the CFTC is the crucial first step in removing that roadblock. Once the regulatory framework is clear, institutional compliance departments will have a legal basis to act. And theoretically, the floodgates for the next institutional bull run could finally be about to open. Following up on the theme of regulation, let's turn to an even weightier piece of news. This one makes me feel like the titans of traditional finance are truly stepping onto the field. The central nervous system of global finance, SWIFT, the very system that connects nearly every bank in the world, has just announced it's getting into blockchain itself. They plan to add a blockchain-based shared ledger to their infrastructure. The goal is incredibly ambitious: to enable instant 24/7 cross-border transactions on a global scale. And the lineup for this is no small affair. On the technology side, they've partnered with Consensys, a core company in the Ethereum ecosystem, with some reports suggesting they might use the linear layer 2 solution. On the network and application side, they've brought in over 30 of the world's top financial institutions, including names like Bank of America, HSBC, and JP Morgan. They're all on the list. When I saw the structure of this alliance, I knew this was a big deal. SWIFT provides the global network and unparalleled industry trust. Consensys brings the technology, and the major banks ensure that the project has real-world use cases and ample liquidity from day one. SWIFT's strategic intent is crystal clear. It's not trying to create an open public chain to compete with Bitcoin or Ripple on the same level. Quite the opposite. It's building a controlled, permissioned consortium chain with the core purpose of tokenizing traditional financial assets like currencies and securities, and then settling them efficiently within its own vast, trusted network of member banks. This is a classic playbook from business history for how an incumbent giant deals with a disruptive technology, which can be summarized as embrace, extend, extinguish. First, it embraces blockchain technology to upgrade itself. Then, it uses its massive banking network to extend its dominance into the emerging world of digital assets. Finally, by providing a compliant, reliable solution that institutions are already familiar with, it could potentially extinguish the living space for decentralized alternatives in the institutional market. In essence, it's using a decentralizing technology to achieve a more sophisticated re-centralization. Furthermore, this project has an even more profound impact. Think about it. What does it take to get over 30 large banks from 16 different countries to transfer value across the same ledger? The prerequisite is that these banks have received approval from their respective national regulators like the Federal Reserve and the European Central Bank.
Therefore, this SWIFT project is acting as a concrete, systemically important driver, forcing global regulators to move from theoretical discussions to practical collaboration.
Its role in pushing for the formation of unified global standards for digital assets may be far greater than any independent policy discussions over the past several years. Okay, let's switch gears to some huge news coming out of the DeFi space. And the star of this story is a legend in the community. Andre Cron, or AC. If you've been in DeFi for any length of time, you know that name. Well, AC is back with a new project called Flying Tulip, and when I first saw this, my immediate thought was, yep, that's classic AC, always coming up with something disruptive. First off, the ambition here is massive. He's building a full-stack on-chain exchange, aiming to integrate everything spot trading, derivatives, lending, stablecoins, insurance, all the core functions of DeFi into one single system. And get this, it's already raised $200 million in a private seed round at a $1 billion valuation. But what really blew me away was the funding model. This time, AC is giving all investors, both private and future public participants, something called an on-chain redemption, right? Basically, think of it as a perpetual put option. What does that mean? It means you can get your principal back at any time. If you invested 1 ETH, no matter how far the token price drops, you can burn your tokens and get that 1 ETH back. This completely upends the traditional VC model of long lockup periods. It shifts the investment risk from you could lose everything to just you might lose some opportunity cost. This design changes the entire game. The project can't just spend the raised capital freely because they have to be ready for redemptions at any moment. So what do they do with the money? AC's plan is to take this massive pool of capital targeting up to $1 billion and deploy it into yield-bearing protocols like Aave and Ethna.
The tens of millions in annual yield generated from that will fund the project's development, operations, and incentives. And the craziest part? The founding team gets zero initial token allocation.
All of their compensation will come from future protocol revenue used to buy back tokens from the open market. When I saw this model, I just thought it was brilliant. It's like a systematic fix for all the problems we saw with the VC model during the last bull run. You know, VCs getting cheap tokens and dumping on retail teams with huge pre-mines who lose motivation and chaotic treasury management. AC is trying to solve all of that with a carefully designed on-chain mechanism. This isn't just about copying traditional finance anymore. This is about using Web3's own technology to create a potentially superior form of capital organization. If this model proves successful, high-quality projects in the future might all adopt it, and that could genuinely disrupt the entire VC landscape in this industry. Now, let's shift our focus to the Layer 2 space. I feel like the L2 wars have entered a new phase. It's no longer just about who can scale Ethereum better. A new strategic high ground is emerging. Who can activate Bitcoin's vast but dormant capital? And the recent major move from Starknet has pushed it right to the front lines of this new battle. The Starknet community recently passed a proposal with an overwhelming 93% majority to introduce Bitcoin staking on its Ethereum L2 network. In simple terms, this will allow users to take wrapped Bitcoin like WBTC and TBTC and use it to help secure the Starknet network. This move is a classic 2-for-1. On one hand, it enhances Starknet's own economic security, but more importantly, it's a strategic play to attract and lock up the massive amount of idle capital in the Bitcoin ecosystem. Starknet's vision for itself is incredibly ambitious. It wants to become Bitcoin's execution layer. What does that mean? It means transforming Bitcoin from a simple digital gold into a productive yield-bearing asset that can participate in complex DeFi applications. Of course, Starknet isn't the only player in this game. You've got projects like Babylon and Botanics, all trying to get a piece of the Bitcoin pie, just with different models. Babylon's core idea is to export Bitcoin's security to other POS chains, while Botanics is building an EVM-compatible L2 on top of Bitcoin. Starknet's model is to have Bitcoin directly serve its own, already active ZK rollup ecosystem. When I look at this trend, I see a much bigger war brewing underneath. This isn't just about L2 scaling anymore. This is a race to become Bitcoin's yield central bank. Whoever wins this race will be able to build an incredibly deep moat for their ecosystem by locking in massive amounts of liquidity. But, to be honest, none of the current solutions are the final form. You see, Starknet is still using various wrapped assets, which introduces centralized or semi-centralized trust risks. That kind of goes against Bitcoin's core ethos of being trustless. So the true endgame for BTC-Fi will likely have to wait for a genuinely trustless, native cross-chain solution to emerge. The computation we're seeing now feels more like a race to claim territory and build a user base with the imperfect tools we have today, all before the ultimate weapon is invented. Alright, after that deep dive into the L2 Bitcoin wars, let's look at a piece of news from completely outside the crypto-native world. When I saw this one, it felt like the whole picture just got a lot bigger. The internet infrastructure giant, Cloudflare. Yeah, the company that handles a massive chunk of the world's internet traffic is launching a stablecoin. It's called the net dollar. But here's the kicker. They're not coming after USDT or USDC's share of the trading market. Their target is incredibly forward-thinking, the AI agent economy. Cloudflare CEO laid it out perfectly. He said the internet's next business model won't be driven by ads and bank transfers, but by pay-per-use and microtransactions. Just imagine your AI assistant automatically booking the cheapest flight for you or placing an order the second an item goes on sale. All these high-frequency automated machine-to-machine payments need a brand new financial infrastructure. The net dollar is being built for that future. I was honestly blown away when I saw this play. You have a Web 2 infrastructure titan using a core Web 3 tool to solve a payment problem for an AI-native era, what you might even call Web 4. This is a huge signal that the future of technology isn't about one paradigm replacing another. It's about a hybrid stack. Cloudflare's project is drawing a very clear blueprint of what that fusion looks like. And if you think about the deeper implications, what will be the underlying settlement currency for the global AI economy? That's a question with serious geopolitical weight. As a publicly traded, heavily regulated American company, Cloudflare's .net dollar is almost guaranteed to be fully compliant. That gives it the potential to become the default medium of exchange for the global AI economy, and in doing so, extend or even reinforce the US dollar's dominance on this new digital frontier. So this isn't just a new product, it's a strategic piece in America's puzzle to maintain financial hegemony in the age of AI. And for our final story, let's look at some major news from the world of centralized exchanges. Even with all the hype around the DeFi, the CEX sector has once again proven its unshakable position in the ecosystem with a massive funding round. The veteran exchange Kraken recently closed the $500 million seed round, pushing its valuation straight to $15 billion. I honestly did a double take when I saw the term seed round. For a mature company like Kraken, using that term is highly unusual, and it sends a very strong signal. So what does this funding really tell us? It shows that no matter how much DeFi grows, for the vast majority of institutions and retail users, a compliant, secure, and user-friendly centralized platform is still the most trusted gateway into and out of the crypto world. Especially after the collapse of FTX, market preference has clearly shifted towards platforms with a long history, a solid security record, and a clear path to compliance. Investors are willing to give Kraken such a high valuation because they're paying a premium for trust and reliability. So what's Kraken planning to do with all this cash? A move this big is typically seen as a crucial step before an IPO. On one hand, it's about making their balance sheet look pristine to withstand the scrutiny of the public markets. On the other, it's about stockpiling ammunition before going public to fund global expansion and to fight a capital-intensive arms race against the giants like Coinbase and Binance. This $500 million is Kraken's war chest for that battle. From a capital markets perspective, this is also a brilliant pre-IPO show of strengths. By anchoring a high $15 billion valuation in the private market, Kraken gains a huge advantage in its future IPO roadshow and pricing negotiations. This valuation becomes a psychological floor, effectively telling Wall Street, this is our starting price for stepping onto the public stage. Alright, that wraps up today's US Stock Market Daily. If you found this helpful, be sure to hit that like button to show your support. Every day, we sift through the noise to bring you the most critical, wealth-relevant insights from the US markets. We hope that by breaking down this curated content, we can help you make more rational and informed decisions on your investment journey. Let's stay rational, move forward steadily, and build our wealth together. May every one of your investment accounts see steady growth. And we'll see you tomorrow.